Well, hi there. So in this video, we're going to be doing extra practice module 27, which is all about how the Fed actually works. This module is super, super important. So I'm really glad that you decided to watch it. The functions of the Fed are kind of, yes, useful, where it kind of goes through the general information here. But these little details here, I'm pointing at my own screen like you can see it, literally right below me where it says the federal funds market, the federal funds rate, the discount rate, you need to know these. So I would get out, sit down, read these things over a little bit before you really go too far into this. If you don't know what these are, you have to know these. It's really, really important stuff. I talk about it in the videos, but it's good practice for you. So let's go ahead and tackle these check your understanding questions. Number one, and there's only one for check your understanding. Number one says, assume that any money lent by a bank is deposited back in the banking system as a checkable deposit and that the reserve ratio is 10%. Trace out the effects of a $100 million open market purchase of T-bills by the Fed on the value of checkable bank deposits. What's the size of the money multiplier? So there's a lot in this one question. But what it's saying is the Fed buys bonds. Fed buys bonds. So right off the bat, we should know the money supply is going to get bigger, right? We just kind of know that, keep that in the back of your head. The other piece is it's saying what's the size of the money multiplier. So we know the money multiplier is 1 over the required reserve ratio. So that's 1 over 0.1, so that's 10. So that kind of, we know that because it says it's 10%. Now we kind of know, well, it's 100 million times 10 equals 1,000 million, or just a billion if you prefer. And that's the kind of value of the change in the change in deposits, is what we can say. And the reason why, right, is because basically they can loan out all of that 100 million, right? And so because we don't subtract, and I'm kind of just writing this so you have it as well, because the banks can loan it all out. And why can they loan it all out? Well, they can loan it all out because the very first round isn't from someone's checking deposit, right? It's the Fed going in and saying, here's some cash, y'all. I'll take your bonds off your hands. You have some cash, so they can loan out all of that. It's not subject to a required reserve ratio. All right, multiple choice, number one. What's the following, and by the way, I really like these multiple choice questions. They're tricky, but they're really good. Which of the following is a function of the Fed? Examine commercial banks, sure. No, they don't print the reserve notes. We talked about that before. Stop trying to get us there. They conduct monetary policy, so D. All right, number two, which of the following financial services does the Fed provide for commercial banks? They clear checks. Yeah, they do the check transfers. They hold the bank's reserves. They do that. And they also make loans to commercial banks. So they actually do all three of those. So number three, when the Fed makes a loan to a commercial bank, it charges the discount rate. That's a simple one. That one shows up on exams a lot. So you have to kind of pay attention to that one, as opposed to the federal funds rate. And that's actually the next, or the second question from next. If the Fed buys treasury bonds from a commercial bank, what happens to bank reserves and the money supply? Well, they both go up, because they instantaneously go up when they buy the bonds, they go bigger, and then they loan them out, the money supply gets bigger. So increase is B. And number five, when banks make loans to each other, they charge the federal funds rate. And that one shows up a lot as well, right? So kind of contrast those two questions. You're going to get both of them, and they're really both good questions. Next question says, what are the 4 basic functions of the Fed? What part of the system is responsible for each? I actually would tell you it's more important for you to do the first free response here. So the answer is actually here. Free response number 1 is way more important. And I am not going to rewrite it here, but I think you should. I think you need to try doing this. What are the 3 major tools of the Fed? Right. So 3 tools, and then how to increase the money supply with each. Those are really, really important. And so right below, it's really important for you to know that answer off the top of your head. It's one that's really important. All right, hopefully you take a look at that. I'll catch you later. Bye now.